And welcome back, everyone, to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning, AJ.
Hey, everybody.
Today is February 4th, and I feel like there is just a lot of news and a lot of action going on in the market.
There sure is. Today the big news is this employment report that came out. I'm seeing flashed over even on some of the news channels, not even just the economic news channels. We're seeing things about the 467,000 jobs that have been created and the 4% employment. And I guess we should delve into that a little bit, Sip.
Yeah, I mean, that's kind of the major economic point today, and really the main driver of today's action. So let's go ahead and check it out.
Well, so the scoop is I actually pulled up the report, and you don't really, I urge everybody to delve into the actual details of these economic news reports and don't just stop at what is being broadcast over by the talking heads. So, 467,000 new jobs created. That definitely blew the doors off of the 150,000 that were expected. And even, the president and his whole administration was talking about that. And they were kind of downplaying, thinking that the numbers would be smaller. We don't know if they were, sandbagging us or not. There's a lot of speculation. In my opinion, who cares? What we want to do is we want to follow what investors are reacting, how investors are reacting, and react with them. It's not important to understand the why. It's important to be reactionary. Most of us on this call are little players, and so it's all about following on the coattails of the big players. They also upgraded the prior numbers. So prior, they said that we had only created that. This is last month. We only created about 199,000 jobs. This month, they're coming back and saying, actually, we went back and counted a second time, and it was 510,000 jobs. So this is really positive for those who are watching jobs. But then a lot of people get confused because the other thing that they're telling us is that unemployment went up by 4%. So if you've ever delved into this report, you kind of understand that the more accurate number is job counts. They actually get these two numbers differently. They actually count jobs created, and that's actually fairly accurate. They get that from the employers and they report the number of jobs that they're putting out on their job boards. The unemployment is more of just a general survey of the public. And so if you're going to give one number credibility over the other, you'd give the job created number over the unemployment rate some more credibility. But also a number that doesn't get reported that I particularly pay attention is this number called the participation ratio. And the participation ratio, it doesn't look like it went up by much. It went from 61.8 to 62.2, but that's the number of people who are in the job force. And these numbers have been at record lows. In other words, a lot of people have taken themselves out of the job numbers over the whole COVID thing. And they've been like, you know what? I don't need to work. I've collected some stimulus. I'm fine. I'm going to go pursue my life. I'm going to, even in my circles, people from all numbers have been like leaving their jobs. They're traveling. They're going to find themselves. They're exploring online education. Well, people are. This is telling us that people are coming back into the job force looking for jobs. And so the scoop is that number is going up, even though we're creating jobs at a record amount. Even when we go back and look at previous numbers, the scoop is that more people, more Americans are coming back in looking for jobs. They're saying, oh, things are good. Wages are up. It looks like it's an employee's market. And so we're going to jump back in. And so that can explain why unemployment has gone up, even though we're creating all these jobs.
Right, and that's good. Like that these are good numbers. The economy is improving, but in terms of investors, good can mean bad, meaning we're so good that we're going to have to slow things down by increasing interest rates faster than we normally do, right?
Yeah, the scoop is, and it's a mixed bag. This could actually be good news on that front too. Right now, it's really been an employee's market, meaning if you wanted to quit your job and go like interview for another job, you could even be picky because you could probably, there's been so many jobs and so many openings and not enough people to fill those jobs. It's been an employee's market. They could quit their current job and they could, go out there and employers have to offer higher wages. Well, now that we're seeing that maybe more people are coming into the market to get jobs, maybe there's going to be a lot less of that, and employers won't have to keep offering more benefits and more wages to get a good employee in. And so that could help moderate. In other words, I'm actually seeing that the participation rate going up. And another thing that's interesting is if the participation rate keeps going up, I think, if it's up around the high 60s, low 70s, I mean, that would be a far time from now. But that actually kind of in history has gone with a population that's happier. People who are employed, making an income, they tend to be a little bit more happier. And maybe that, I know I'm getting out of my comfort zone with discussing numbers, but I just looking at previous history, when people are employed and just bringing in a nice salary, things are a lot more happy than when there's a lot of people unemployed or out of work and having a lot of free time on their hands.
Sure. I bet we would all vote for an overall happier world, right?
Yeah.
At the end of things. Looks like the market has turned down
Mhm.
about half a point or so, or half a percentage point from the news. But that also might be due to some of the stuff that's taking place in the tech sector. I know that yesterday was a big earnings day for Amazon and Facebook, both of which are moving in opposite directions from it.
Yeah, although Facebook is moving down faster than Amazon is moving up, and that's something to be aware of. It has a lot to do, I think, with the interest rates and the news about raising interest rates. Wall Street doesn't like when money starts getting tight. They like it when money is flowing. But, here's the scoop. Um, Tech stocks have always been that play that is a little bit in investors' minds on the volatile or risky side. And so when money gets tight, they're going to start taking their money out of tech stocks. One thing we're seeing across the board, by the way, let me go ahead and pull up our web portal. This is the members only web portal that we have. And we have an area in here. Let me get rid of some of my chicken scratch on the screen. We have an area in here called just the index stats, where we get a nice summary of what's been happening. And this is going to be the summary from yesterday. One of the things I've been noticing, especially over the time, is that everything is moving either up or down together. And that's not, when you have a fully saturated market, that's actually not how things move. You usually see money moving around from one type of investment to another. And so what I actually believe we're seeing a little bit is a shakeout, right? We had a lot of people in 2021 enter into investing, whether it was because they were looking for another source of income, or if they had more free time on their hand, they had more free capital on their hand. But a lot of newbies came into the market. It was like the year of the retail investor. As soon as things start looking sour, I think that retail investors are going to start, going back to different investments that are a little bit more passive, a little bit more secure. And so we're seeing these ups and downs because there's a whole portion of people who entered the markets that maybe aren't in there for the long run. And once they, decide to moderate their income, I think we're going to start seeing now where the money that stays there will start showing us moving around to the different bonds, to stocks, to commodities. we'll see that sort of movement rather than seeing everything going up and down. Speaking of everything going up and down, um, I want to give you guys a little technical something here. So I want you to keep in mind because here we are looking at this chart of the S&P 500, and I want you to also. I keep talking about how the talking heads don't do a good job. I talked about that with respect to the employment report and how they leave out key parts of data that could make a better picture for those of us out here. But also, they talk when they talk about the market. I've been hearing all this information just in the past week about how the market's on a rebound. The talking heads don't tend to look past the tip of their nose. And as investors, we need to look past the tip of our nose. I'm always cautioning our program participants about that. And so one way to look at that is to pay attention to retracements, right? And here on this chart of the S&P 500, we're looking at the last downturn. And what I like to keep track of is how far back up do we retrace? In other words, if we retraced back up over 100%, in other words, we made a full retracement and went further, I would be thinking about trend changes. So we were in a downtrend, and if we reversed over 100% back above this line right here, I would be thinking about a trend change. What you're seeing here is we only reversed about into the center of that channel. These two pink lines that I have here define the center, and they went about just to the edge of the center, about 60% of the way back up, and now they're turning back down. To me, that is not any sort of rebound. What that is to me is a test of the current downtrend. And so everybody was talking this past week, oh, we found a bottom and we're rebounding. I would never think we were rebounding unless we got over 100% retracement. Anytime we have a retracement less than 100%, I always think, nope, we're just testing the current downtrend. So I think we've got more to go.
Yeah, and we've got the economic and the earnings news to drive a move down like that faster than with just waiting for things to happen.
The scoop is when things get tight. Let's go back to one last topic, and I know we're all over the board here, but Facebook versus Amazon versus Alphabet, which is the company that the new name for Google, and I guess Facebook now is trying to call themselves Meta. What I don't even know what that means, but the scoop is when now investors are going to turn their sights towards something more safety oriented rather than the tech stocks. Now there's going to be a competition in between the tech stocks about who's going to get the scarce investment dollar. Facebook, for the first time, is not showing any sort of new subscribers. They kind of plateaued. They're not showing, upticks in money. They're showing that they have to spend a lot of money on rebranding their company. They're spending a lot of money on competing against like a new platform like TikTok is, it seems like TikTok's stealing Facebook's shorts.
Yeah, the one thing from the earnings report that everyone was pointing out is Mark Zuckerberg mentioned it 5 times in the mentioned. I mean, you don't usually go around mentioning your competitor 5 times in an earning report unless you're scared.
And not only that, if you think about it, and I'm not sure he thought about this, but by mentioning TikTok 5 times, he brought that exposure to TikTok to investors that maybe didn't even know what TikTok was. So he probably added fuel to the flames.
Yeah. And as an advertiser, just to touch on that, I do see a lot of potential in the TikTok world of generating revenue because they have built themselves following what works on Facebook. And it seems as if the consumer is beginning to enjoy the experience a little bit more, right?
Absolutely.
But a 26% hit in your market cap in one day, I mean,
And that's happened to them in the past. I mean, it's happened to the biggest ones like Tesla. It happened to Amazon. It happened to Microsoft. These tech companies do have those days. So I'm not at all worried for Facebook, but at the same time, it is the biggest one to date, and it's maybe signs of things to come.
Sure. So we'll keep an eye on that. I know the numbers just came out yesterday, so it might take the next week or so to flush out, the realities of what's happening. But that's really not how we do things here at Trading Trainer, right? We
No,
don't want the exciting stuff. We want the boring stuff.
that's
And
right.
so it sounds like we've got a new ticker to be looking at. And yeah, what do you got for us?
And I have to give kudos to the people in my program. Last night we had our members only workshop where we go through symbols that the folks in our program are interested in. And one of our program participants brought up Goodyear. So let's take a look at Goodyear stock, GT. So Goodyear follows our dream pattern in that it's boring, it goes sideways. They offer a very nice dividend. I mean, they do very good in their earnings. It's just one of those symbols where people are going to need tires. They're
I was
going to
just
need the services offered by Goodyear. Go
I
ahead.
was just gonna touch on that. It goes back to one of these real things. Like every car needs tires. Tires blow all the time. They need to be replaced. A beautiful product at a beautiful price with beautiful price action.
Yeah, absolutely. And so you'll notice that, and one of the things we look for before we start even being interested in in a particular symbol is that it tests its levels of support and resistance at least two, if not more times. And so you can see that Goodyear's personality has totally done that. And it clearly goes between support and resistance. And so we're actually, thanks to the program participants last night, we're going to start watching Goodyear, and I want to raise people's um, awareness about Goodyear as one of those fantastic premium stocks. I mean, you can see that our best fit trend line is slightly going down, just ever so slightly. So what we are thinking of doing as a program is we are thinking of letting this underlying symbol come back up towards the top. And once it finds its top, we're thinking covered put as the type, legging into a covered put as the type of investment we would pursue here. So we're waiting for this thing to come a little bit higher. It is retracing. It's following the broad market right now, but we're expecting it to come back up in the next week or so. And once it kind of tops out here, we're going to start the process, short some stock. It's at an inexpensive enough price for us to short the stock itself. We found that the back month puts don't have much liquidity, so this would have to be a shorting stock play. And then you wait for it to bottom out, and wherever it bottoms out, that's where you're going to write your put, and at the same time buy a protective call, probably buy a protective call with the $25 strike price. So it's a two-step legging in process, and we're being patient, waiting for it to top. But I wanted to identify this because this wasn't even on my radar.
Yeah, and it looks like a perfect setup. The question that I have on this is because we always bring up the options expirations. What is that number? How does that compare to this setup?
Okay, that's a great question. So, because we're not using a back month option, there's just not much trading on the back month option. And so, for those folks that are out there, we're talking about liquidity, right? Because options are created by you and me, they're not created by companies. And so, if nobody is out there trading the options, then you don't want to be the only person. You don't want to buy them now, and then when you go to sell them, you go to the room where there's buying and selling happening, and you're the only person in the room. So instead, we're going to short the stock. There's no expiration on shorting a stock, so we don't have to worry about that. What we do is when it comes down and it becomes the timing signal for us to sell premium, that's when we want to, at that time, evaluate two things, SIP. One of them is going to be how long to expiration. And ideally, we want to find one that's 3 to 5 weeks. So 3 to 5 weeks. Now, we could use the monthlies. I would imagine it's not going to be this March option by the time we come back down. It could be, depending on how fast it comes down. But I bet we'll be looking at April options at that point when it gives us the signal to sell the put premium. Or you could do weekly options. And so you can, make it exactly 3 weeks by using the weekly option. So that's where the expiration date. The second thing you look for is the strike price. And you'll basically, wherever it bottoms out, you'll err to the side of out of the money. And so, for instance, if it bottoms out at $18.75, out of the money puts would be at $18. If it bottoms out at $21, then, or I should say $20.90, you'd sell the 20. So you kind of play it by ear based on where it bottoms out and when it bottoms out. When it bottoms out, you go 3 to 5 weeks out looking for the next expiration date. Where it bottoms out, you just err to the side of out of the money.
Awesome. Yeah, that makes a lot of sense. Yeah, and on that, it may be a little bit complex for somebody that might be joining the stream or the channel for the first time, but AJ does have a wonderful daily workshop that he broadcasts, and I'm gonna go ahead and play our little commercial and invite anybody that hasn't checked it out to check it out. And then after that, we'll go over some of the symbols that some of our other users, fans have thrown out, and
Definitely.
we'll dissect those. And in the meantime, if anybody else has any questions about a specific ticker, feel free to throw it in the chat, and we'll see if we can mix it into the show.
Throw it in the chat. I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, and I remember that day. AJ was just zooming around everywhere in hyper mode.
Yeah, that was a fun day. You guys, you got to check out that workshop. It summarizes this premium selling very well. It'll make it make sense. It's a good 45 minutes, 50 minutes out of your day to be able to go through that workshop and see what's up.
Yeah, and excited for anybody new to join. So, with that being said, we've got some tickers that have been mentioned throughout the week, and I believe we're going to start off with an airline, JetBlue.
Yeah, JBLU. This comes from Jean-Michel in Montreal. So Jean-Michel said, is JetBlue one of the candidates that I could sell premium against? So Jean-Michel, this is what we would do. We would take a step back. And so I'm taking a step back. I'm looking at a 2-year chart. Obviously, I can see some drawings that I've done in the past. And I know I've been interested in JetBlue in the past. In fact, I like all of the airlines. I'm going to get rid of my drawings for now. What I like to do with any type of symbol is I like to take a step back, taking my own advice and not, focusing on the tip of my nose. And I like to understand, where are the big personality changes? And so I can see just from here that we started to go in a certain direction, a sort of sideways direction, right about here in the middle of July. And so I might take a look, or I like using a best fit linear regression drawing tool to get kind of an idea of what's happening. And once I have that, I can now zoom back in and start worrying about what's happening more in the present. So if you take a look here, JetBlue is for the most part going sideways. It has a little bit of a downward trend. We could totally sell premium on it because it has this downward trend. In my mind, Jean Michel, I want to think about every time it moves down, it's in what I call range expansion, range expansion, range expansion, because it's expanding in the direction of that overall downtrend. And every time it moves up, I call it range contraction, right? Range contraction. And so to summarize, every time I have range expansion, I want to let my position, my back month position, just go on its own. So in this case, I would look for an opportunity to either short some stock so that every time I'm in a yellow arrow, that stock will appreciate for me. Remember, when you short stock, if the underlying symbol price goes down, you make money. And then every time there's range contraction, that's the opportunity to sell premium. You stay in your shorted stock, but then you write some call premium and buy yourself some I got my words backwards. Write some put premium and buy a protective call. And every time you buy a protective call, you just go above the previous channel. That's your protective call strike price. And as we just talked with SIP, the premium that you would sell, the put premium you would sell would be 3 to 5 weeks out. So you'd go and you'd find the expiration date that's about 3 to 5 weeks out, and you'd do something that's basically at the money, erring to the side of out of the money. And you just keep rinsing and repeat, and that's going to be giving you that income from this symbol, as well as giving you the long-term appreciation of the sorted stock. Now, I do want to ask you, Jean Michel, have you looked at the other airlines? In other words, if you're looking at JetBlue, one of the ones we've been looking at the past is Delta Airlines and also American Airlines. There's also United Airlines. Those are all also symbols. Any airline, I think, is one that's going to be good for selling premium. They're a stock that just keeps going, keeps going, keeps going. It takes something like, the scare of a pandemic to throw the airlines off. But otherwise, they keep going, and they don't seem to, do any better than staying boring. And that's kind of what we like when we're looking for symbols to sell premium on. So think about all the airlines, but JetBlue is definitely doable.
Yeah, and it's in that like $20 price point. That's really nice for a lot of these strategies.
It absolutely is. It's affordable.
Yeah. The next ticker on our watch is one that we've covered on numerous episodes, and that's going to be Wendy's. I guess their burger sales are doing well, or
Yeah.
not.
Wendy's, this came from Todd in Oklahoma City, OKC, okay. So Todd was asking, hey, this thing went down, and now it's coming back up. Should I have sold my premium? We talked about, shorting Wendy's if you wanted to, and then selling the premium. And so here's the scoop. We had seen that Wendy's had gone lower in the past. And I bring back that tool that I described in the beginning, the retracement tool. So if this is a retracement, this remove up did not retrace, close to the 100% zone. Instead, it reversed much lower. And so the scoop is, I've got my trading cat here who wants to sit on my lap. I apologize, everybody. That's Sparkle, the trading cat. She must have something to tell me about the economic news happening right now. Amateur hour is about over now. So
she heard burger and
that's probably more like it. She heard the word burger and she's like hungry. Coming back. So the scoop is no, I wouldn't sell premium here, and the reason is because we didn't get low enough and we didn't verify that we were on our way low. I think we're just taking a break here. One of the things I can tell premium traders is to relax, right? You don't have to hit your timing expertly perfect. In fact, a lot of times showing restraint and making sure that all the planets are aligned, whatever timing mechanism you're using. If you're using signals off the MACD followed by some price patterns the next day, I would let this thing do its full movement as your trading plan should have told you. You know, we're looking for it to come somewhere between 21.79 and $20.30 before we sell premium against it. At this point, this little foray back up would have been an opportunity for us to, short some more symbols at a discount price. But this is too early for us in this channel to sell premium. So just put on the brakes, get zen on yourself, and just follow your trading plan.
That's right. And our third question in the lineup is a generic question.
Yeah, this is Jim. Jim sent me in a question. I think it was actually through our blog. You guys can check out our blog at tradingtrainer.com. It's not called a blog, it's called articles that I've written. But he put a question there. This is Jim from Tampa Bay. And he was asking about, the overall process. And I thought this question was so fantastic. The overall process for being an investor with these type of investments. And here's what I have to say to you, Jim. Pipeline, pipeline, pipeline. You have to have a pipeline of symbols. You have to not just focus on one symbol at a time from start to finish, because that will not make you into an investor. You need to have your whole portfolio invested to actually make money on it. I've seen folks that have like $100,000 portfolios and they're only investing like 7,000 of it at a time. And you're not going to make any money on your money if the other 93,000 of your $100,000 portfolio is just sitting there idle. You have to have a pipeline. And so here's the process I go through. I have underlying symbols I'm interested in, a watch list. And on that watch list, I'll create trade plans. From those trade plans, I will back test those trade plans, not only to find out if those trade plans work, but also to understand what signals, what timing signals I need to pay attention to make the plan work. Then, after back testing, I'm going to take that intel from the back test, the timing signals, and my trade plan, and I'm going to forward test or real-time simulate test with a paper trading account that symbol. And I'm not going to paper trade just that one symbol. I'm going to be paper trading somewhere between 5 and 15 symbols, because then as you follow these real time, following your plan for each, using that intel from the back test, using your timing cues and following it, you'll find over the next 3 to 4 weeks, some of those symbols will come to the top in qualities like ease of trading, profit return, and risk, minimal risk. And those are the ones you'll then start doing real money. But that doesn't mean you stop, looking for new ones to forward test, new ones. You're always adding to your watch list. You're always creating and updating plans. You're always back testing, and then you're always forward testing. I have, in addition to having my whole portfolio invested, I have a parallel paper trading account where I'm basically forward testing all of these symbols so I know which ones are floating to the top as the best of the best. So when my portfolio has a moment where there's a position that cashes out and I've got a chunk of change, I don't have to wait. I don't have to fill my pipeline and go through that whole process. I already know what symbol's been performing in my paper trading log, and I just, then look for the opportunity to get into it with that chunk of money so that I'm constantly keeping my portfolio invested. So it's so important that you keep your pipeline filled. Once you have your pipeline filled, to maintain it takes only a few minutes every evening. I don't think I spend more than 10 or 20 minutes every evening just maintaining my pipeline. But to get a pipeline started, it literally takes weeks. So put the time in, get it started, and then maintain it. I think I spend more time in front of the mirror brushing my teeth and popping zits than I do maintaining my pipeline.
Yeah, and that watch list and some of the tools that you mentioned and the strategies, all that can be found in the link in our chat. If you go through the workshop, we'll give you information on how you can get involved and all of that. So great
Yeah.
question, wonderful answer. Watch lists, watch lists, watch lists.
And pipeline. Keep it filled. Don't just follow one symbol. Don't follow one symbol, because then you get into a relationship, weird kind of codependent relationship with that symbol. I see people come to me and they're like, I want to trade this symbol. I'm like, that symbol's ugly. Why don't you look at something else? Well, I've been following this symbol. But it's like, just like, people who like, you always have that friend that's been dating like a slob, and you're like, why do you still, I don't want to find somebody new. It's too hard. Well, have a pipeline even in your dating life.
Yeah, that's right. That's right. That's the motto I live by. And there's thousands of things to choose from, which is kind of what makes investing exciting, thrilling, difficult, is that there is so much information. All
That's
right,
true.
and in our last question, we're going to be talking about silver.
Yeah,
Uh,
this is from Steven. Steven is down in Melbourne, Australia. And he asked me if it's possible to sell premium against commodities like silver. He's really interested in silver. And the answer is yes, ETFs. In fact, everybody's been talking about the SLV. And so I definitely think that if you want to sell premium against something like a commodity, you find an exchange traded fund that follows the silver price. We love SLV. And SLV has been a ongoing producer of returns, very minimal risk. Silver, as you know, as a commodity, Stephen, is quite boring. Everybody gets excited about gold. Everybody's been getting more excited about crypto, but silver just kind of lives there. And silver also has a lot more industrial. They put it into solder and stuff like that. So, silver's got some uses above and beyond just being a precious metal. But it's one of those ones that kind of gets overshadowed by gold. And so I love it for that reason. These are not detractants. This makes it a fantastic premium selling. So you could definitely sell premium against the SLV ETF.
and
And I would.
it's got that price point too. Once again, that 20, and then I'm just wondering, liquidity, which does bode to one of the questions that someone just asked that maybe we could roll into, and that's a question from Jose. And Jose asks, do you look at open interest or volume when you are looking at liquidity?
Oh, I love that question. So first, let's actually use SLV as an example, uh, because there are ETFs, and I'm not going to say every ETF, but ETFs on a whole have more liquidity than individual stocks. Now, of course, there's some stocks like, a Facebook or a Ford or a very popular name that's going to have a lot of liquidity. But in general, the more popular ETFs have more liquidity. And so take an example, as I'm going to go to the near term option here. So this is the option that is expiring on February 18th in a couple weeks. And so open interest defines how many, and this is the public information. There could definitely be contracts written privately that aren't showing up on the big board. But open interest is the number of contracts that have been written that are currently in circulation. And so 133 contracts, that's a good number. In fact, any number over 100 is really good. If it's over 50, that's fairly liquid too. So I do look at open interest. Volume, out of the two choices you gave me, and I'm going to give you a third choice. Volume I like to look at to see if it's traded in that particular day. But for most of the stuff that I do in the premium selling, I don't need to see volume every day. So I like to take a quick check and see, has it been traded today? You can see some of these strike prices in the February option have already had, like this particular one, the at the money $20.50 strike price. It has 4,454 open interest, and already today 232 of those contracts have changed hands. That tells you it's very liquid. But here's the third one that I actually give the most credibility to above and beyond open interest and volume, and that's the bid-ask spread, the difference between the bid and the ask price. So you can see right here, this particular option that we were just looking at, it's got a penny difference. That means that it's very liquid. You have to understand that if there's not a lot of liquidity, the bid-ask spread is going to enlarge. And when I see a bid-ask spread, especially for an option that I would want to buy and sell very quickly, how I'd want to see no more than maybe 20, 25 cents at the most between the bid and the ask price. If I start to see more than that, I know that the buyers and the sellers aren't having a meeting of the mind. They're very far apart. And that tells you, just to give you a bigger explanation, that tells you that the market makers, the folks who come in with some money that are creating liquidity in the market for the rest of us, the market makers are seeing that, because there's very little trading, there's very little buying and selling, the bid-ask spread is getting larger, so they can make a bigger chunk of payback, because they're either going to make money on volume, so the number of transactions that happens, they don't have to have as big a bid-ask spread. But if there's fewer transactions happening, that bid-ask spread is going to get wider, so that the market makers can make their same, totals at the end of every day. So I look at bid-ask spread, I look at open interest, and last but not least, I look at volume.
Awesome. Appreciate all the questions from everyone. As always, feel free to drop a question into the chat, and AJ will get back to it as quickly as he can. If you're watching on one of our streaming channels, go ahead and hit that follow, subscribe button. We do our best to try and get this content out, at least this show, once a week, and then we break down some of the best parts of it. And with that being said, heading into the weekend, AJ, anything that we should be keeping an eye on?
Let's follow and understand back on that S&P 500. Let's pay attention to those retracements that I brought up. Let's see if indeed it does look like we're reversing, although today so far we have this thing called a doji bar. So let's absolutely watch, and let's see if we don't go even farther. If we have a range expansion greater than 100% from this last one, that's going to be all telling. It means that people are pulling their money out of the markets. But I'm not worried about that. I feel like it's just a shakedown of investors that weren't in there for the long haul anyway. I'd almost like to see the market get back to some of its usual, more predictable behaviors before all these like amateurs got involved.
Yeah, and you know that the talking heads, even if we do pull back within reason of a chart analysis, it's going to be, oh, the market is tanking and the lowest of the, worst returns in a year.
They have what I call Chicken Little, the sky is falling syndrome. But you know what? And I have to put this out there as a parting thought. Option traders can really take advantage of pullbacks in the markets. We don't have to do anything besides buy some, leveraged puts. And so I urge you, if you're starting to hear all this noise about how the market's backing up, instead of pulling your money out of the markets, instead get some education about options trading, because option traders, first of all, when people pull themselves out of the markets, there's fewer people to divide the winnings. And remember, the markets, money isn't lost in the markets. Money simply changes hands. So if you understand how to put yourself on the right side of the equation, and now instead of being in a group of 100 to collect that windfall, you're in a group of 10 because the other 90 people checked out, they just got afraid. Your payback is going to be quite great. So I want to tell you, as much as you're saying to yourself, oh, there's all this noise about getting out of investing, now is when you want to be in investing, and now is when you want to be on the right side of the equation.
And that's exactly what we teach here at Trading Trainer. And with that, if you haven't checked out the workshop, go ahead and hit that link in the description. Drop any comments or questions into the chat. And with that, I believe
Should they see us on TikTok? I think we have a TikTok channel, don't we?
we do have a TikTok, but we're working on cutting down some of your rants.
Check me out on TikTok, everybody.
But yeah, hit that follow, ask the questions, and be sure to tune in next week when we'll be live streaming again.
Yeah. And keep sending in those questions. If you're watching this on a replay, keep sending in those questions. Thanks.
All right, guys, have a good weekend.
Bye, everybody.